Hey everybody, Bob Adams here. Welcome to Navigating Your IQD Investment. This is a quick review from MaxPlans for Life, Inc. Before we get started, we do have a disclaimer. All information, discussions regarding the Iraqi dinar, events, taxes, and plans are for educational and entertainment purposes only, are general in nature, and not intended as investment, legal, or tax advice. Each person's personal financial situation is unique and different, and the information provided may not apply or work effectively for you. Effective and established financial tax planning needs to be done by you with licensed professionals of your choosing. By signing up for and attending or participating in our informational internet or in-person workshops, seminars, and follow-up meetings, you agree that MaxPlans for Life, Inc. and all affiliate companies, representatives, associates, or employees, information providers, are hereby held harmless from all liability and loss associated with the information and discussions provided, and as to any action or strategy you may choose to implement with regard to the same. There are several steps to accomplishing the best results for your IQD investments, and you've already taken the first one, which was you invested in the IQD. So let's take a look at the tax side of this game that we're playing in. The IQD is not considered a capital asset, so it will be treated as ordinary income. Exchanging your IQD for personal use creates a taxable event. Most IQD holders will want to exchange some or all of their IQD when the RV is announced. This will be an understandable approach, but it can also destroy your IQD gains. By just cashing in your IQD and creating this taxable event, you've automatically exposed your new gains to federal and potentially state taxes. The best ways of using this approach is to slowly exchange your IQD over time, keeping in mind your personal tax bracket. We call the approach of cashing in your IQD for immediate use the freedom tax, meaning you pay the taxes up front and then you're free to do as you will with the remaining amount. The freedom tax option is done with the understanding of exchanging your IQD carefully to reduce the highest tax brackets, which is your personal tax bracket. To take full advantage of the freedom tax, look at how much IQD you have on hand, look at what you want your IQD investment to accomplish for you, compare tax options like your age, your health, and overall desires, and exchange your IQD to meet your dreams after looking at those considerations and consulting with professionals. Now, one more time, this is a warning. The most tax expensive portion of your IQD tax plans is the freedom tax, so use it wisely. The following slide will show the tax brackets and how the freedom tax is calculated. Here are the tax brackets for 2022. I'm only showing 3 different filing statuses. Each one of these has 7 tax brackets. And you'll notice that they are calculated differently for each one of those depending upon whether they're single or if it's an annual combined income. So since the IQD is going to be taxed as ordinary income, it'll be subject to both the federal and state taxes depending upon which state you reside in. So here's an example of what the freedom tax could cost you if you had $1 million to exchange. Now this is the federal only. So your status is single. You'd pay 37%. The IRS would get of that $1,365,000 and some change, and you get 300 or 634 and some change. Now if you're married, they're going to take 360,000 and some change, and you'll get 639 and some change. And the head of household, they take 363 and you get 636. Now you'll notice there's not a lot of difference. Okay, they're really close to about the same based upon you just cashing it all in helter-skelter. Now, based on that, cashing in obviously the large amount would be very expensive. So here's an example of the freedom tax would cost you for $100,000 exchange. Now this is the federal only, one more time. So you're single, that would only be a 24% tax rate. So you would give up $20,988. Essentially, you would keep about $79. If you're married, it's only a 12%. So you would get about 9, and they would get about 91, and head of household would be 22%, and they would take almost 18, and you would get about 82. Now notice there's some huge differences when exchanging it for a smaller amount based upon your filing status. Now, let's make a comparison for 10 years. So if you're single and you cash it all in, wham, there's 37%. They take their 365, you get 634. If you only did 100,000, it'd be 24%. They would take 21, you'd get 79, and over 10 years, it'd still only be 24%. They would take 209, and you would get 790. So essentially, you would save $155,000 over a 10-year time frame by just slowly exchanging it. It's the same thing with married, 37% batch yield, but it's only 12% if you do it at 100K over a 10-year time frame, and the total savings is almost $250,000. That's a lot of difference. And of course, head of household, same story one more time. So being aware that exchanging it all up front costs you a lot more money than it is to exchange it over time. Now, of course, the obvious side to this is that we don't know what the value is going to be over time. But this is an option. So you got it? Cool. So using the freedom tax option can be very expensive. So rushing to the bank for an exchange because of fear and just cashing it out could destroy your IQD investment desire. So taking your time to get professional assistance before rushing to the bank, it could literally save you millions. Now consider this. If your IQD investment's less than $2 million, catch your breath. Watch for the best rates. Contact professional assistance. Consider not cashing out to purchase that new home, but just getting enough for a down payment. Carefully invest the rest of it to create some sort of set-for-life income. Charitable donations to IQD can be a feel-good option because people just want to give IQD to their charities. But exchanging the IQD for your personal use and then donating the USD could be more cost-effective. One more time, your tax professional will help you with that one. Having smaller denominations of IQD could also reduce some of that freedom tax bite. So if you're exchanging a 10K note versus a 25K note, yeah, that would save you some money. So carefully use the freedom tax options. So let's take a look at something called gifting assignments. Now, the reason preparing the anticipating gifting assignments are it reduces your estate tax exposure. So if your estate tax exceeds certain limitations, the governments, both federal and state, can assess a tax on them, and thus reducing the value going to your heirs. Now, identifies your intentions to share your IQD funds by who's receiving your gift, the date of the intention, this has got to be prior to the RV date, the amount of the intention, which can be filled in later, assist in your overall planning based upon the amount of IQD you have and the anticipated rate. Now, consider creating multiple assignments for each recipient. That way you can share at one value and have another option to share much later if there's a huge change in the rate. Do not give out the gifting assignments until after the RV and have the recipient sign the document when they receive the IQD from you and retain the signed document for your records. This must be created before the RV. Now, I want to talk to you a little about what's called a gift tax return. A gift tax return is a federal tax return that must be filed under certain conditions by the giver of a gift. That would be you. The key takeaways would look like this. The givers of the gifts worth more than $16,000 to a single recipient must fill out what's called a gift tax return with their annual tax return. Some gifts are exempt from this rule, including gifts given to pay tuition or medical bills. The gifts must exceed a lifetime amount of $12 million to a single recipient to be taxed. So how the gift tax return works, essentially, the individuals who give a gift that exceeds the annual or lifetime exempt gift limit established by the IRS must fill out Form 709 when filing their tax returns. So what about gifting IQD? Well, because of the $16,000 cap, having to file a gift tax return, we use the gifting assignments to identify the person and the date, which shows the IQD value to be much less than the maximum of $16,000. Because right now, you can buy it, for $1,000, around that for $1 million. So you can give them up to $16,000 worth, before you have to worry about it. By having the gifting assignment prepared prior to the RV, you've opened up the door to reduce the potential of bumping up against the estimated estate taxes. So the purpose of doing the assignments is to identify your intentions to share the gift prior to the RV at the lower rate and can be used as an estate reducing strategy later on. So since we don't know the rate, which is why we do multiple gifting assignments for each intended recipient, the more assignments we have, the better prepared we will be. So it's much better to have them and not need them than to need them and not have them. So you got it? Gifting assignments are an easy way to, quote, cover your butt in case your holdings bump up against the estate tax considerations. So gifting assignments are meant to provide a way to share your IQD at the current rate without actually having to give the IQD out to your intended recipients at the moment. Making multiple gifting assignments to each individual leaves the door open in case the IQD increases dramatically and pushes your estate tax into a tax exposure. Remember, you create the gifting assignments for each individual you anticipate sharing the IQD with. You do not give them the documents until after the RV, and when the RV happens, you can determine the value of your intended sharing and insert it in the document. Now, they give the gifting assignments to the individual with the IQD. Have them sign the document, return it to you. Now, this must be done before the RV. The actual document preparation must be done before the RV. So let's take a look at the precious metal Roth. Now, the reason for establishing a precious metal Roth for your IQD investment is a tax-free gains for the future. Preparing for anticipated medical expenses can be of value. Use it as a legacy to pass on to your heirs. And you can use the Roth as part of your IQD investment options. Requires considering the following things. Your current age. Are you too young? Having a tax-free environment for the majority of your working career is really a great idea. However, some people don't have the patience for it. Are you too old? The Roth can be a great way to prepare for anticipated extended medical care or a legacy to be passed on, but if you're over 65 to 70 years of age, it may not be a good idea for you. It must be active earnings, meaning that you can't use retirement accounts. There's a 5 calendar year aging process, which starts in January of each year, and you have to be at least 59 years and a half to be able to withdraw it, be tax-free and penalty-free. Now, the IQD must be purchased from a dealer by the custodial service provider. And you must use a vaulting service to secure and insure your IQD. Now, what that essentially means is that you aren't going to be able to keep the IQD on hand, and you cannot use the IQD that you have on hand. It has to be purchased by the Roth. So here's an example. The Roth is a tax-free option available to completely eliminate taxes on your IQD investment. So here's an example. $1 million, okay, exchange, this is federal only. Single, 0, you get $1 million. Married, 0, you get $1 million. Head of household, 0, you get $1 million. Now notice, this is the one and it's the only way to have a completely tax-free gain for yourself. So let's talk about the precious metal Roth tax-free and penalty-free options. So whatever gains you have in your IQD Roth are considered tax-free, which means you can literally never have to file a balance due tax return again. The funds in your IQD Roth can be shared with others and be tax-free for them as well. Okay, that means when you die. You can actually withdraw any initial contribution tax-free, but you can also withdraw any gains the first year penalty-free. Still taxable gains, though. So you can withdraw gains at any time, qualified or unqualified, tax-free and penalty-free for the following reasons. Taken out because you have a permanent disability, made by your beneficiaries or estate after you pass away, or used to buy, build, or rebuild a home that meets the first-time home buyer exemption. This is something that is new, that was just brought in with the most recent administration change. So, first-time home buyer. I want to talk about this just for a brief moment. So if you're buying, building, or rebuilding your first home, you're allowed to take a distribution of up to $10,000 or $20,000 if you're married from your IRA Roth to fund a portion of your cost without paying taxes or the 10% penalty. Now, there are a few restrictions, though, and here's the official wording from the IRS, like they have to say. It must be used to pay qualified acquisition costs before the close of the 120th day after the day you received it. It must be used to pay qualified acquisition costs for the main home of a first-time home buyer who is of any of the following: yourself, your spouse, you, or your children's spouses, or your child, your or your spouse's grandchild, or you and your spouse's parents or other ancestor. Now, when added to all your prior qualified first-time homebuyer distributions, if any, total qualifying distributions cannot be more than $10,000. So essentially what it's saying here is you can develop that Roth, get it going, and be able to pull out of it up to $10,000 for your first home. Hey, that's kind of cool. All right? Now, there's some other ones, too, I want you to be aware of. First of all, you can get out of the 10% penalty, but not the tax. So if you pull it out early, you got to pay the tax, but not the penalty, if you take distributions for the following reasons: unreimbursed medical expenses that exceed 10% of your adjusted gross income on your AGI, your medical insurance premiums after losing your job, an IRS levy. Like that's a surprise. Qualified reservist distribution. So if you're a qualified reservist as a member of the military service who's not active, but when called to duty, you're eligible to be able to pull some of these funds out. It'll still be taxable, but not penalized. And then for qualified education expenses. Now the term qualified higher expenses, QHEE, refers to money paid by an individual for expenses like tuition, books, fees, and supplies to attend a college, university, or other post-secondary institutions. These expenses can be paid by a student, spouse, parent, or another party, such as a friend or another relative. So, do you got it? The precious metal Roth is the only way to have a tax-free return for yourself. You can use the Roth as a way to ensure your heirs get a tax-free inheritance if the stepped-up basis is taken away from us. Now, that hasn't happened yet, but it is a possibility that it could be taken away. I'm not going to go into detail about that, but your professional will know. The Roth requires the funds come from active income only, or they're rolled over from an IRA or a Roth. You cannot use passive income, retirement, Social Security. Limited by income caps based upon the filing status. It must age for 5 years and until you're 59 years of age to withdraw tax-free. You can exchange the IQD before meeting the aging requirements to be invested and put into an annuity. So let's say, for example, like you went ahead and opened it up. You're only a year into it. The RV comes to fruition. You can go ahead and exchange that IQD in the Roth and then put it into an annuity. Let it grow until you achieve the 5-year waiting period and you're 59 and a half. It's included in your estate planning, so get a professional assistant, and it doesn't cost any more to add more IQD over time for the custodian vaulting service. This is one of the things that's really cool. You can start it with $1 million. You're allowed to add up to $6,000 per year contribution if you're under 50, $7,000 if you're over 50, and you can add to it and add to it and add to it and add to it as you go along in life. It doesn't cost you anything more for the maintenance on it. Has some penalties, tax-free options in case of emergencies and planning, and this has to be done before the RV, while the value of the IQD is still as low as it is. Now let's take a look at a CRUT. This is one of my favorite options that's available to just about anybody. The reason for preparing the CRUT now, but not activating it until the RV, number one, the CRUT can be the perfect option to capitalize on a favorable exchange rate without having immediate freedom tax obligations. What that means is you can exchange the IQD at the highest possible rate and pay no tax on it. None. None. It's a great way to make sure that the fluctuations of the dinar in the future makes no difference to you. You went and exchanged at a rate that was acceptable for yourself. The documents, they're all completed prior to the RV. The rate of the IQD RV will be a determining factor of when. That's up to you, not anybody else. You decide. The amount of IQD USD is invested also as part of the calculation. Once the desired rate is available to you, you deliver the documents, the EIN and the IQD to a participating bank. You invest the now exchanged IQD for USD and customary investments, perhaps in options provided by your bank or other financial institutions, or even an annuity. Keep in mind the option to create a private foundation so the funds in the CRUT can be used after your passing to perpetuate your personal charitable desires for potentially many generations. This is one of the facets, one of the nuances about the CRUT that I really like a lot. Because you have to identify which charities that are going to receive the funds after you pass, but you can create your own private foundation. And once it's established as a 501c3, those funds can go to it, and your heirs can do something with it. Now, this is initiated after the RV, but having the documents prepared now will speed up your option to take advantage of the most favored IQD exchange rate. So I want to show you something that's really cool about the CRUT. And I look at it and say, this is the tax benefit. This is why you want to look at the CRUT. So if you're exchanging IQD without a CRUT, let's say you're going to do $1 million, okay? Cash it in if you're single. That's $329,000 that goes to the IRS, $297,000 if you're married. You know, single balance, you'd have $670,000 left essentially to invest and $702,000 to invest if you're married. So they get their cut first. You have to invest it after that. Then you add the state, county, and city taxes, which we don't know what those are. And you potentially lose up to 50% in all these taxes that nab you and grab you, okay? And the other part is that when you invest those funds, the 670 or the 702 or whatever it ends up being, all those gains are still going to be subject to more taxes. So you're starting out losing potentially up to 50% before you even get it started. But if you use the CRUT, first of all, there's no taxes. It doesn't matter what it is. City, county, state, it doesn't make any difference. It mattereth not. So you get to invest that $1 million, okay? You do pay taxes on it, and let's just say that over for the next 20 years, you would pay $85,960, okay, if you were single, $51,860 if you were married, but the city state tax account would be less also. So 100% of your $1 million went into investments and future gains, which are tax-free. So as long as it's under the umbrella, it's tax-free. So by using a CRUT, you essentially save $243,000 if you're single, $245,000 if you're married. That's another $250,000 back in your pocket that went back into being invested to help you along. That's why I like the CRUT. It is a great, great option for the future. Now, I want to show you the three-way win with the CRUT. Let's just say we're going to start with $1 million. So you've got your CRUT, you got $1 million you put into it, and you decide to purchase an annuity, just as a number to play with. So you have a potential income stream of about $50,000 a year for the rest of your life, and possibly receive over $1 million while you're alive, meaning you live more than 20 years. Subject to ordinary income taxes, which defers from freedom tax obligations. Okay. Now you select those charities that would receive the balance, possibly over $1 million, on your passing. Well, that's kind of cool. You've created a legacy. That's awesome. But you can also add a death benefit. Can't guarantee it, depends upon your age and your health. But potentially, your heirs, upon your passing, would receive a $1 million life insurance policy, which would be tax-free to them. Pretty dang cool. And then finally, after you got this thing established, you could also create a private foundation. And then, instead of giving the money to up to 6 different charities, all of it would go to that private foundation, which could then be managed and administered by your heirs for multiple generations to come. I love the CRUT. It really is a great option. So let's take a look one more time, because the CRUT really is the gateway to lots of things that can happen. Okay, it defers and reduces taxes on that IQD exchange. We don't have a tax when we make the exchange. It can offer you and your spouse a lifetime of income at a lower tax rate. It can offer you and your spouse 20 years of income if you're under the age of 40. It can potentially offer a death or a long-term health care benefits. It can be invested in various options to maintain or increase its value, and all those growths inside there would be tax-free. So every buy and sell, exchange, whatever, doesn't make any difference. The other cool part is you can add more IQD to it. It can give my remaining funds to up to 6 charities of my choosing, and I can also give my remaining funds to your private foundation and maintain your charitable desires after you're gone. So, in your private foundation, this is the cool part, could potentially provide income to your heirs and their heirs for generations yet to come. And it also reduces your estate taxes. I love the CRUT. It really is a great option. So, have you got it? Can you see the value to it? The CRUT is an amazing option, okay, to be used after the RV. The pros are it can be prepared for now, so it enables a quick activation if the RV reaches an acceptable amount. Opens the door for tax-free exchange of your personally held IQD to be invested. You receive 5% per year or monthly, quarterly, semi-annual, or annually, however you want to get it. It can include your spouse, so if one passes, the other one continues to receive it. It can be invested in an annuity with a guaranteed income for life. It can include death benefit, for insurance payment to your heirs. It can also include long-term health care insurance for yourself. It can satisfy most IQD investors' desires for retirement income, legacy charities, and family benefits. And the cons are the funds in the accounts are not passed on to heirs directly, but it can be passed on to your private foundation in which they can be participating and be paid. The return of 5% limits the possibility of a full recovery. Depending upon how old you are and what your health looks like, you may not get that full $1 million back for yourself during that time frame. But it's a guaranteed payment. No ifs, ands, maybes, or buts. You must be 38 years of age to create a lifetime income. You can do it for less than that, and for 20 years if you're younger than that. It should be created prior to the RV simply because we don't know what the rate's going to be. All right, now that's a lot of information. Let's just put this whole thing all together. So using the freedom tax, the gifting assignments, the Roth, and the CRUT together as your final plan. So the freedom tax should be used wisely for immediate needs only. You'll want to secure professionals to assist with the other options and protection. Create your gifting assignments to reduce potential estate taxes. You got to understand, estate taxes change. Every administration does it different. Right now we're at $12 million per person, $24 million if you're married, but in 2025 it's supposed to drop back down to $7. And if the Democrats get their way and what they want to accomplish here, it could go down to $1. So having the ability to be able to unload some of these things that we've got on here before it bumps up against that cap, that's why the gifting assignments are so important. The Roth, which provide you with tax-free gains for anything that you want. It can be passed on to your heirs tax-free upon your passing. Okay, the CRUT, it just simply opens the door to exchange your IQD at a favorable rate without any immediate taxation. It satisfies most of your desires for a legacy, retirement income, charities, death benefit insurance for your heirs, potentially creating your own private foundation for future generations. And you can add more IQD as the value increases to defer taxes, but have a gain on your income. Now, this will reduce your estate tax exposure. Once you put the funds into this is an irrevocable trust. It has no bearing on your estate. None. They can't touch it. The CRUT can support you until you reach the aging requirements to access your Roth gains for some people. Now, this is the best combination to provide a potentially tax-free retirement until you're taking advantage of your IQD revaluation with deferred taxes. So let's take a look at some practical applications. And I've got kids at 19 years of age who've got Roths, amazingly. But they have enough sophistication that they know what they want to accomplish within that umbrella. So let's just say you're young, and you've got a lot of IQD. So you want to carefully exchange your IQD for the needs, remembering those taxable rates. Gifting assignments, make them. You may never use them, but make them anyway. The Roth, now you can't get into it till you're 59 and ahead, which can seem like forever. But the value of the Roth is applicable to younger generations. Now, the thing I like about it for younger generations is you can use it to buy your house. You can use it for emergencies. But most importantly, any kind of exchange that happens inside that Roth is a non-taxable event. So when you take over managing the Roth, you can invest it in lots of different ways, and you don't have to file a tax return on it. It's really a great option. Use it to pay for some schooling, your first home, and in case of medical or other types of emergencies, put part of your gains in an annuity with a guaranteed income and invest the rest as you desire. Now, the other consideration is maybe consider putting a CRUT together. That way you got a tax-free exchange. You get 5% payments for 20 years. Then move the funds to a private foundation for the balance of your life and potential generations. All right, between the 40 and 60, obviously, the freedom tax is still going to be available, and remembering those taxable rates. Gifting assignments, one more time, estate taxes become a problem. As you get older in your career and you've acquired, many assets somewhere along that line, those gifting assignments become very, very important. The Roth, depending upon time retirement, becomes more focused. The funds there in case of any kind of an emergency in your retirement potential, for the annuity, for unqualified period. And the CRUT is just the perfect way to meet your personal desires and secure an income for life. It meets your legacy desires and offer your heirs a tax-free insurance benefit besides the option to create a private foundation. Now, if you're 60 and over, it's another ballgame. Because let's take a look. Seriously, how much longer are you going to be here? What's your health like? All those types of things go into play here. So the freedom tax, well, of course it's going to be there. But when you get older, you don't necessarily want to do some of the things you did when you were younger. And so it's a different ball game at that point in time. But you still want to exchange some of your IQDs and have the experiences of life. Your gifting assignments, yeah, that's going to be important to get those put together to reduce that potential estate tax. You got to remember, guys, that's the most volatile. That's the most horrific thing about our tax situation at the moment. We have no control over it. And so just be aware. The Roth, it can still offer those tax-free gains, but also your heirs would be able to get it to them tax-free. You got to remember, though, it's got to come either rolled over from a Roth or an IRA if you're not actively working, and it'll be a great way to pass on those gains to your heirs. The CRUT, now it's a possibility. It's the possibility to a perfect way to meet your personal desires and secure a tax-free insurance benefit for your heirs or via a private foundation. Now, if you're 60 plus, who knows how much longer you're going to be here? And realizing you're only going to get 5% out of this thing. The value to it is the next generation, because those funds can actually be moved into that private foundation, and then they can carry it on for multiple generations from there. So MaxPlans for Life, who presented all this information for you, there's 4 options to maximize your IQD investment. These are the tools and the things that is being brought to the table to help you with this investment. First of all is the gifting assignments. We have digital ones that are available. You can make as many of them as you want. The purpose is to reduce and eliminate those estate taxes. The Roth, we have a tax-free environment for a great return. We are not a custodial service. What we do is we make sure you get the right one and that the documents are completed in a timely manner. The CRUT, yeah, we do have the documents for that. We make sure everything gets done. It does defer taxes until you start withdrawing them, and it can be used with an annuity for a lifetime income and a great legacy. These are the things that we bring to the table. And then finally, one of the things that I feel is probably the most important is the MaxPlans members website. Because on here we've got ongoing information, resources, and webinars. There's a lot of information there to keep you up on what's going on in the IQD investment world. So if you want to come on board and do just the gifting assignments only, and there are some people that want that, you're going to get unlimited digital preparations for your gifting assignments and access to the website, but the cost is a one-time fee of $100. That's not too costly to be able to get access to all that information and to make sure that your estate is going to be okay. If you want the Roth only, well, guess what? Not only do you get the assistance with that, but you also get unlimited gifting assignments. Same thing you had before, and access to the website. And it's a one-time fee of $500. If you want just the CRUT, and for a lot of people, that's just the answer for them. Of course you get that CRUT with all the documents preferred and everything set up, ready to go for you. And you also get access to unlimited digital assignments. You also get access to the website, and it's a one-time fee of $2,500. Now, let's just say you decide you want it all. So the full MaxPlans IQD options look like this. You get assistance with the IQD Roth, you get unlimited digital preparations for your gifting assignments, and you get the CRUT in all its completion and everything ready to go and access to the website. That full package is $3,000. So the benefit to being a member of MaxPlans for Life, yeah. Webinars on taxes, annuities, estate planning, all those things there, access to updates on IQD availability, bank and exchange centers like Workabank, easy updates for additional programs and products. To become a member, you just simply select any of the products, put them to work, and you're set. Now, because of the recent activity of the IQD, we're all aware of the gains being completed in Iraq right now, particularly consideration that there's going to be more demand for oil from them in the future and the potential changes in the value at any time. So MaxPlans for Life offers assistance in ensuring our compliance with IRS codes and those changing tax policies. One more time, the fees look like this: $100 for the gifting assignments, $500 for the Roth, $2,500 for the CRUT, and $3,000 for the full package. Understand we're not saying the IQD is going to revalue in the immediate future, okay? But there appears to be a favorable window at this particular time as we have these new contracts being brought into bear. So if you got it, that's it. That's everything. These are the greatest options. We consider these to be our vanilla options to be able to get you through the best opportunities with your IQD investment. Obviously, when this thing comes to fruition, you're going to want to get professional help. And we encourage you to, and we actually show you the resources of where to find attorneys and CPAs and financial planners. All of that's included. So this is your opportunity to put all those IQD plans into full functionality. The gifting assignments, the Roth, the Charitable unitrust, the free information. Click the links above to make your appointment with me. There's a free 30-minute conversation regarding your IQD situation plans. Please complete the questionnaire to take full advantage of our time together. Okay, and then include the name of the person who referred you to this presentation. And remember, you own the IQD investment. It doesn't own you. But now is the time to prepare. Thank you very much for your time. I'm looking forward to having a conversation with you.